everyone, and welcome back. You're watching The Money Show on ET Now. Let me finally now introduce on the show Pankaj Bansal. He's the Chief Business Development Officer with bankbazaar.com. Pankaj, great to have you with us today on The Money Show. So like I was telling our viewers, we want to start off by talking about the latest announcements that have come in, from the government, from the Supreme Court, from the RBI as well. This pertains to new home loan borrowers, and of course there's also all that announcements with respect to those individuals who have taken a moratorium between April and August, and now of course with the latest government announcement on that interest on interest bit, which we on The Money Show as well have highlighted several times. So Pankaj, let's start off first with the RBI announcements. Now usually, we always tell our viewers as well of The Money Show that look, if the interest rates are cut, then you could expect, especially those individuals who have their home loans or their loans linked to MCLR or repo, should see a reduction in their interest rate or in their EMI bill as well. This time around there's been no change in the interest rate, but there were announcements specifically for home loan borrowers with respect to risk weightage. So it's a bit jargony, especially for our retail audience and our retail viewers. So if you could break it down, does this mean anything for them? Is there going to be any change in home loan borrowing?
Yeah. So I think, the first thing that I want to put it across is that the exact mechanism of how banks will waive the interest on interest is still not clear, right? So nevertheless, waiving of compound interest on the outstanding amount during the 6 months of moratorium, as stated in the government's affidavit, will bring a very small relief to borrowers in our understanding. So to give you an example, I'll tell you, for example, if you have taken a home loan of 8.5%, right, the difference between your simple interest and your compound interest for the 2 crore would be typically around 15,000 bucks. So I think the difference is too small to start with. I think that's the first thing that I would like to put up for our viewers. But the second point to note out here is that this accumulated interest still would be very high. And because it's been paid through the entire tenure of the loan, right? This is because the unpaid balance of the loan is compounded not only over the 6 months time frame, but it's across the entire tenure. So as far we understand right now, from our understanding, is that the waiver on compound is only during the moratorium. Second, once your moratorium is over, your outstanding has also gone up, your EMIs but remains the same, and that means the tenor will also increase. So I think what I would suggest for the benefit of the viewers out here is that we should look at a bounce back strategy, which is nothing but we'll have to prepay our at least 120% for EMIs in the next 1 year. For example, if I have to pay around 5 EMIs in the next 12 months, I should be looking at to pay at least 11 EMIs in the next 12 months or so. What this will do, Mubina, out here is that this will erase the burden of the additional interest, right? You will have to pay. And then obviously the loans will be regularized as per the EMIs left. I think that's a very important strategy that the viewer should look at when you're pursuing the moratorium impact.
So for small loan borrowers, that's basically people who've borrowed under 2 crore rupees. The government has said that, look, we'll waive off the interest on interest and the government will bear the burden for you, for banks, whatever commercial burden that, the bank will let go of by, waiving off this interest on interest. However, Bank Bazaar does recommend that, look, if you have indeed taken the moratorium, still pay that 120% or 1.2x, to sort of normalize your EMIs. It's still a recommendation coming in. But yeah, Pankaj, I actually was asking you in my earlier question about the RBI risk weightage. Does it mean anything really for home loan borrowers? I mean, can they expect maybe that tomorrow if they go to the bank, they'll get a loan more easily?
So I think, yes, I think if you look at what has happened, the risk weightage from a monetary perspective, there were two components to one. One was the loan value. Second is loan to value, which is basically the amount of loan that you'll get from a risk perspective. So for example, if I'm taking an 80% plus, the maximum risk that a bank has to put it from a provisioning perspective was about 50%. So what will this do? This has got little lighter from a regulator perspective. So the banks will have more liquidity to play and they can disburse more loans without putting a lot of money aside for this thing. So you will see a liquidity easing happening because of this lowering of the risk weightages on the portfolio.
Okay, so there will be a little bit of liquidity that essentially comes into the system because of the fact that now the risk weightage will sort of decrease, as the RBI as well has suggested. Okay, let's talk now Pankaj, about the whole bit with respect to the loan recast. Now, there are several banks that have come out with loan recast policies. The government as well, or rather the RBI as well, said that each bank will come out with their own loan recast policies. So I guess while the broader instruction pamphlet, if you could call it that, has remained the same, it's the finer details perhaps that will differ, I guess, by a small amount between banks. But largely, do you suggest that if individuals who've already opted for the moratorium but are feeling the pinch right now, or may have been able to sail through the moratorium period but now suddenly have faced some sort of conundrum with respect to their finances, do you think they should go ahead with the loan recast program?
So I'll explain that in 5 basic bullet points. In terms of loan recast, I think there will be a cost associated for borrowers. For example, SBI has already started charging an additional 35 basis points for the remaining tenor of the loan, while HDFC may even charge a processing fee around it, right? Second is that, when you opt for a moratorium, it clearly implies that the repayment capacity of the borrower is impacted. Banks have always, in the historical world, has charged a premium depending on the repayment capability of the borrowers, and the spread of the loan would have a component, right, of the risk premium among other factors. So this becomes very transparent when you see an external benchmark linked rate, which is EBLR loans, where the risk premium varies by as much as about 140 basis points, and on the credit score of the borrower. So I think the repayment would only start after the moratorium is over. So lender can assess the repayment capability of the borrower only after the repayment starts. That's one. Second is the restructuring is not a right for the consumers, unlike your moratorium that everybody was covered under the moratorium bid. In certain cases, bank may even deny of restructuring a particular loan depending on the risk profile of the consumer. If there is a very high risk that they see, they might even not offer this restructuring to these customers. And third point I think I would like to put forward is that the restructuring need not only be a moratorium, right? There could be an extension of the loan, which you can see. But the only caveat moving out here for the benefit of for the viewers is that this loan extension cannot be more than 2 years, right? So you cannot extend more than 2 years of the tenure of the loan. Second, I think what banks can even do is sanctioning of additional credit facilities to address the financial stress of the borrower on account of obviously COVID-19. And if there is no renegotiation of existing debt, so they might even release fresh lines to these borrowers. I think that could be the third point to ponder for consumers. Fourth, I would say is that this restructuring, right, may impact the credit score of the borrower. And I think if you look at the RBI circular, right, it's very clear in the resolution framework for COVID-19 that the credit reporting of borrowers shall reflect as the restructured status if the revision of the loan could be classified unstructured under a prudential framework. So there will be a flag which comes as a restructured status. So when there is a flag which comes like a restructured status, you might see that the borrower may have an impact on the future loans that he borrows from the market. Because obviously, as per the prudential framework guidelines, any lagging indicator of financial stress is now being put across on the report of the credit report of the borrower. I think that's the fourth point that the borrower will have to consider. Our view is that keep restructuring from a consumer benefit perspective as our last option. In case if you have done everything from your side, you're not able to get anything, and you're really facing a lot of cash flow issues, I would suggest that you should opt for restructuring. Otherwise, we would completely recommend that we should not look at and explore this option for the benefit of the viewers.
All right, Pankaj, just let me just take a short detour from our ongoing conversation and address Britannia Industries numbers very quickly. It looks like a good set of business, more or less in line with expectations. But again, from Britannia, that's what one can expect. The revenue from operations have grown by a little more than 10% is what I can see, just a back of the envelope calculation, at 3,419 crores versus 3,048 crores. There has been a good beat on the margins though. The EBITDA margins have come in at 19.8% versus 16.1%, and the profit after tax as well has grown, outpaced revenue growth, 495 crores versus 402 crores. So I guess revenues and profit after tax are in line, but the margin has managed to beat expectations. So I think it's a good set of numbers coming in from Britannia Industries. Let's see how the numbers react. Remember that Britannia being a foods company, firstly, of course, it had seen its biscuits fly off the shelves during the whole pandemic and during the lockdown, especially in May and June. So the Q1 numbers did see that, but has that pace continued, of course, is going to be key. And then secondly, we are seeing this inflationary trend in India, especially in food prices. We have the farm bill as well that has come in, so it'll be interesting to see on how Britannia will do in terms of its cost of production front. But Pankaj Bansal, stay on with us, and folks, if you have your questions and queries, now is the right time to call in, or rather email us on the Money Show at etnow.tv. We will be continuing our conversation, and of course answering your questions and queries as well when we return from this short break.